how the session was organized. Given that the session is virtual, I think invariably there is a bit of an issue in terms of connecting with the audience. So I think a poll of this sort is more a pulse, a feedback from you to us as to how you found the session. Yeah. So please do use that. This will be at the end of the session for audience's use. Thank you so much. Mr. Suman, if you're still having trouble, I think we can just go ahead and start speaking and get around to, I think we shouldn't keep the audience waiting. So.
Okay, thank you.
Thank you so much.
Thank you. I don't know, I have to find out how the WebEx I'm using, I've generally utilized from my phone, but today I'm first time trying to utilize from my laptop, and then I'm trying to find out where the camera is. I'm familiar with Teams and other things, but it's okay.
I get that. Yeah, sure. Please go ahead.
I think today the subject is very good subject, where we see that there are a lot of benefits in terms of social welfare through this scheme, but I think we do not know the entire scheme and how it operates. And thanks to CII for organizing this session. And we have very eminent speakers today here in the panel. Let me introduce one speaker after another. So first, let me introduce Shri Supratim Bandyopadhyay, who is the chairperson for PFRDA. Mr. Bandyopadhyay has assumed charge as chairperson, Pension Fund Regulatory and Development Authority, which is full form of PFRDA, in 21st February 2020. Prior to this, Mr. Bandyopadhyay was a whole-time member finance in PFRD for 2 years. He's having a very vast experience in the field of insurance, served around 3.5 decades at Life Insurance Corporation of India, LIC, which is the largest life insurance company in the country. And during his tenure in LIC, I think he has worked in various capacities, heading 2 large divisions as Chief of Investment in LIC and Executive Director in Investment in LIC. He also held the position of Managing Director and Chief Executive Officer of LIC Pension Fund. So who can be the right person to talk about all these things? And thanks to CII and thanks, sir, for agreeing to CII to have this session. And Mr. Bandyopadhyay's areas of expertise include finance and investment, and he has also served on the board of Central Bank of India. He was in the Supervisory Committee, Investment Committee of Venture Funds. And Mr. Bandyopadhyay is a science graduate and a qualified chartered accountant. He loves reading books and listening to live classical music. That's about Mr. Bandyopadhyay. Mr. Bandyopadhyay, welcome to the session. We will be very eager to know everything out of the program today, and we will be waiting for your session. Then let me introduce another stalwart, Mr. Suranjan Banerjee. Suranjan is a consulting actuary with over 13 years of experience in the domain of employee benefits consulting. He started his career at Aon, where he was involved with preparing and delivering funding and accounting advice to corporate and trustees. In his current role, he delivers advice and reports to clients based in the Indian subcontinent, which cover various aspects such as governance, accounting, funding, asset liability modeling, and the other DC-based solutions. DC-based solutions mean such as National Pension System, NPS. So, Mr. Banerjee, thank you for agreeing with us and welcome to the session. We will be very eager to hear your perspective on this. Next, I would like to introduce Mono M.G. Phukan, who is General Manager, PFRDA. He is presently working as General Manager with PFRDA. During his tenure of 10 years at PFRDA, he has worked across verticals and he has experience of promotions and development fund management by pension funds, record keeping operations and functioning of NPS Trust, where he worked for 3 years. Prior to joining PFRDA, Mr. Mono worked with IDBI Bank as Deputy General Manager and with Corporation Bank as a Product Manager, and his banking experience of 12 years are in the field of credit appraisal, retail assets, liability business. He started his career with Nestle India as a sales officer in the year 1998. I have so many friends in Nestle, just to give you the context. He holds a degree in Commerce, MBA and CAIIB. And last but not the least, we'll also have a speaker, Ms. Behrooj Kamdeen, who is a partner in Deloitte India. Ms. Behrooj has over 25 years of work experience in corporate and international tax to companies with focus on financial services and technology sector. She has advised Indian financial institution on the Indian tax laws and rules implementing the US tax law, Foreign Account Tax Compliance Act, and the OECD Common Reporting Standard. For the people who doesn't know OECD is Organization for Economic Cooperation and Development. That's a European body, but yeah, the European companies operating in India has a major stake with them. She represents client at tax authorities and appellate authority and the authority of advance ruling. She is a regular presenter and writer on tax topics relevant to financial service sector. Thank you, ma'am. Thanks for agreeing to coming to this session. We will be very eager to know you. And Deloitte is also, I have so many friends in Deloitte India. So again, welcome to the session. Thanks. Let me pass on to the moderator then and start the session with the first speaker. Merin.
Yeah, please. Thank you. Thank you. May I now actually invite Mr. Suranjan Banerjee to make his presentation? I think we are sharing the presentation rights to you right now. So, Mr. Banerjee, can you hear us?
Merin?
Yes, hi.
Hi. Okay, I think I have.
Yeah, I think maybe Mr. Chairman can go first.
May I? Yes. May I invite Mr. Chairman, please? I think I made a mistake, obviously. So may I invite the chairperson, please, onto the dais? Thank you so much.
Good afternoon, Mr. Mitra, and all my co-panelists today. And thank you, CII, once again. We have been engaging with CII for last more than a year, and we had many such webinars through which we could reach out to the corporates, the employers, and over the years we have seen a lot of interest being generated from the different corporates to know about NPS, to onboard their employees into NPS. So the initial remarks, I'll be talking briefly about the pension landscape in India and what are the issues that we are grappling with. Next will be Mr. Suranjan Banerjee. He is, as already told, he's accomplished actually with a lot of interest and a lot of experience on retirement benefit planning. So he'll be talking from their own survey as to what the employers want, what the employees want, and where is the solution. Thirdly, my colleague, there is a small change actually where it was shared. Mr. Mono Fukan was still a general manager. Recently, he has been promoted and currently he is chief general manager. So he will be talking about the NPS system in detail, the nitty-gritties, how to onboard, what are the charge structure, what kind of benefits are there. And lastly, to round it off, nothing of when we talk about a financial product can be complete without the implication of tax. So that our senior tax consultant, Madam Behrooj Kamdeen, will be rounding the entire discussion off with that. And thereafter we'll be ready for taking the question and answers. So when we talk about retirement benefit planning and pension per se, we have to talk about the demographics. Why at this point of time we are talking suddenly about the retirement benefit planning? What is so important about it? Actually, what is happening, we have a lot of demographic dividend that a large part of our population is still in the working age group. But what we have to understand that India is aging and aging very fast. And as you go around, and when we have seen during this vaccination process, when it was opened up initially only for 60 plus people, that itself was a challenge because maybe more than 10, 11 crore people are there who are to be covered. So unless this thing had come up, we never would have understood that more than 11 crore people are there who are above 60 years of age. And the rate at which the Indian population is growing, all expectations are that by 2027, our population of India will be the highest in the world, even will be beating China also. Secondly, what is happening, not only India is aging, but the longevity also is increasing. Earlier, say 50s or 60s, the kind of longevity that you used to see. Here, the longevity has increased quite a bit, and to a great extent due to the advancement in medical sciences and the kinds of treatments which are available to us, and at the same time, with increased per capita income, we have access to those kind of treatments today. Today, at birth, the expectation is that any person in India will reach the age of almost 69 years when they die. That is the longevity expected at birth. But when a person reaches 60, what is the longevity expectation? It is almost 18 years. And there also we have to understand one thing is that for women, it is even more, maybe 1.5 years more than their male counterparts. And it is true not only for India, everywhere across the globe, wherever we have gone, we have seen, wherever we have shared the data with whatever country, we have seen this is true for all the countries. Even in countries like Japan, the expectation, longevity expectation post 60 is almost about 80 up to 87. So this is a phase post retirement, post working life, when people have to really take care of their finances so that they can take care of their health and they can take care of their regular expenses and requirements. So that's why talking about pension has become absolutely necessary at this stage. Because for a period too long, we have not paid much interest in the pension part of it. We thought that if we are getting a good salary, somehow we are having our own business and generating good revenue, that is enough for us, and we maintain our current lifestyle, that is enough for us. But a time will come, even people who are in their business, their working life will come to an end, and ultimately they have to depend on a pool of money, a corpus on which they can spend their retired life easily. If you look at the Indian pension landscape, it is pretty scattered. I can say that there are a lot of agencies who are giving some kind of a pension or retirement benefit. You start with EPFO, they started way back in 1952. It was only initially Provident Fund. In 1995, they added another part into their investment corpus, that was EPS, Employee Pension Scheme. So there also some kind of a regular payout is made when people retire. Of course, there are certain limitations to that. Then from government side, there was an old pension scheme. It was a unfunded, it was a DB scheme. DB scheme means there are two kinds of pension schemes. DB is a defined benefit scheme. There, even if you don't contribute at the retirement stage, whatever is your last drawn salary, maybe 50% of that will be paid to you for infant. And not only that, whatever is the DA increase at regular intervals, that also will be added to that. Then came the DC schemes. DC schemes have defined contribution. Why the changeover from DB to DC? Because after all, even government also felt the heat that financially it is difficult to maintain that DB scheme because of the financial consequences. Because it's a huge outflow of from the government exchequer. So in 2004, government shifted first from DB to DC, defined contribution scheme, where they said that a fund is to be created. Who will be the contributors? Employer will be the contributor and employee also will be the contributor, and they will have equal contribution of 10% each. And then the concept of NPS. Initially, it was called New Pension System. Then it was renamed as National Pension System that was formed. And as authority, PFRD was the authority to have a regulatory oversight over the NPS scheme. Apart from EPFO, today PFRDA, there are institutions like IRDA. IRDA also regulates a lot of superannuation schemes. They are managed in a different fashion, but ultimate aim is to give pension. Apart from that, there are many other specific kind of provident funds like Siemens Provident Fund, Coal Miners Provident Fund. But when we total up all these things, even SEBI has some pension schemes. Some of the mutual funds, they have offered pension schemes. Though whether it will actually give you pension or not, that is another issue. Because these schemes mostly have 5-year lock-in period and thereafter you can withdraw your money. So what you do with that money, that is absolutely your choice. Whether you buy an annuity, which will give you regular income, that is also your choice. But so far as the superannuation schemes managed by IRDA and NPS managed by PFRDA, the ultimate target is a certain percentage of your income corpus will be converted into annuity so that it ensures a regular income, which is the ultimate outcome of any retirement benefit solution. So with all these EPFO, PFRDA, IRDA, controlled funds, everything coming in, we see that our total pension assets in India as a percentage to GDP, hardly it is 13 to 14%. Whereas in some of the developed countries, like if you look at, say, US, 147% of the GDP is the pension assets. UK is 123, Australia 135, like that. Even other BRIC countries also, apart from maybe China, everybody is ahead of India. China, of course, data sometimes is not available in totality, so we cannot comment on that. But even we have seen that Brazil is ahead of us. Russia is ahead of us. So I believe we have a lot of catching up to do, and that's why we have to think more about the longevity aspect and take care to ensure that we build our corpus as early as possible. Today, through CII, I believe we'll have a lot of corporate these things will be participating, employers will be participating. For them, I can only say that more than 9,000 such employers, such corporates, they have already joined NPS system. The number looks quite impressive, but when we translate it into the actual active number of members who are there from the corporates, it is not even 12 lakh. So that shows one fact, maybe the corporate has taken a membership, but only few of their employees have joined. This, I think, in the technical term, it is called the take-up rate. So take-up rate is pretty low. So there, I feel the corporates have to take a lead in encouraging their people to join NPS quite early in their life, so that over a period of time, 30, 35 years, they can really build up a corpus without much of a strain. Because normally what we see in corporates also, people join at a later point of time. And by the time they join, it is maybe late 40s or early 50s. They have very little working life left with that particular corporate. They are going to retire, superannuate. And they don't have enough time to build up a really serious kind of corpus which will see them through. The issue that really bothers everybody is that why people are not thinking early. Is that maybe they think that it is 30, 35 years ahead. The kind of money I am earning, it will automatically take care of all my needs. But that does not happen simply because of the fact of life that there is a concept called inflation, which really eats into your corpus, whatever corpus you build. And ultimately, if you feel today sitting here that maybe 50 lakh is enough for me, 5 years down the line, you will realize that 50 lakhs is not enough. I have to build on that corpus even more. After Pfrda started, as I said, we started with central government employees, then we went to state government, then we started with corporates. We allowed even retail customers also to join in. So retail and corporate all taken together, we have 29.5 lakh customers only. Out of our total base of 4 crore 40 lakh customers we have. Majority of them come from central and state government, and a large part come from scheme, which is a guaranteed pension scheme, which is APY, Atal Pension Yojana. There we have almost close to 3 crore customers. So a large part comes from APY and then from central state government, and obviously thereafter it comes from the corporate sector and the retail customers. What is there in NPS which should attract your attention is that the product is very, very flexible. Of course, the detail will be given by Mr. Monofukan. Just 2-3 issues I want to highlight. It is very, very cost efficient. Just one small example I want to give. Now we have increased the fund management charges of our fund managers. 7 fund managers we have, we increased them. After increase, you know what are the charges like? You give me 100 rupee for management. I charge for every 100 rupee 9 paise. 9 paise, just imagine. Look at any other sector, whether it is mutual fund or whether it is a unit-linked kind of insurance plan, the kind of charges you have to pay to the fund manager to manage your funds. So we do all our things very, very cost effectively. As a result, the net return is given to the customer who is benefited. Very flexible. Today you are in private sector, you want to go to a public sector company, you can just move with your NPS account. You need not close it down. You need not stop contribution. You want to leave your job and be on your own, you change. You go to private sector and retail sector, you change. There is inter-sector shifting. That model will help you to change, and thereafter you continue. Very flexible so far as the contribution is concerned. Minimum contribution may be say 1,000 rupees a year, and thereafter, according to your cash flow, you can continue to contribute. If you want to contribute even 1 lakh, 2 lakh, there is no such limit as to how much you can contribute. Obviously, under PMLA, Prevention of Money Laundering Act, whatever you contribute in any financial instrument, it has to be supported by your known sources of income. So that is the only condition. Beyond that, there is no financial limit as to how much. There is exclusive tax benefit about which both Mono and Madam Veros will be talking about. And lastly, which comes, and I believe it should be a point for consideration of the corporates also, the kind of returns that we generate. Now, since inception, I think in our equity funds, we have given return, which is a CAGR, is about 11.3%. On corporate bond funds, it is more than 10.2, 10.3%. And it is a experience of last 12 years I am talking about. It is not just last 1 or 2 years. So last 12 years has seen many interest rate cycles, many inflation cycles. And through that, our fund management capacity or fund managers have proven that they can manage through different, even challenging cycles also. Last 1.5 years has been very challenging, not only for all of us from health point of view, but for the financial market also. But we could wade through that uncertainty quite well. So with that, I don't want to take much of time, but again, I want to thank CII for giving us this platform. And I believe today's discussions will be very, very fruitful, and we are ready to answer all the questions that are given to us. Thank you so much.
Thank you so much, sir, for your excellent address. May I now invite Mr. Suranjan Banerjee to share? Yeah.
Yeah, hi, Miran. Thank you for that. Can I just check that I'm audible and that you can see my screen?
Yeah, we can see your screen. If you can put it into a presentation mode. Yeah, I think that's taken care of.
That should be better. Just give me 1 second. Yeah, so that's fine, right? You can see the
We
full
can,
screen
and we can hear
slide.
you. Yes.
Okay,
Thanks.
perfect. Yeah, so thank you so much, Mr. Chairman, Merin, for the introduction, Mr. Mitra, and a very good afternoon to everybody who's on the webcast today. As always, it's a great pleasure and a privilege to be speaking at one of these events and to share the virtual panel with such distinguished individuals. Just a quick note to say that we thank the CII and the PFRDA for providing or continuing to provide us these opportunities to interact with the industry. Okay, so today I'll be speaking to you about retirement benefits planning. And to this, my approach will be to present some survey results. We're in that business of we like doing surveys, and then we like reporting out what the surveys reveal. Obviously, these are surveys which have, well, some of them have been run before COVID-19. One of them we actually run every 2 years, so the next one is up for running this year. And of course, some of the other ones we run annually, so there's one again which is due this year. But having said that, I think the results and the thoughts that are coming out through these surveys, are unlikely to change significantly over a short period of time. So what I'll do is I'll actually take you through some of these results over the next few minutes. And like Mr. Chairman actually mentioned at the start, so I'm going to present to you sort of both sides of the coin. So the first survey is going to look at how corporate sector employees are feeling about their retirement benefit savings. I think the survey itself, while it was carried out in 2019, where we interviewed several thousand individuals across countries about a wide variety of topics which related to their current financial situation, and this included, as you can imagine, a significant section on retirement benefits. So I'll speak to you about what we thought was coming out, generally across the globe, and then more specifically, aspects from the Indian side, which of course we'll all be able to relate to a bit more. The second study was actually done last year again. So both these studies are actually due this year, and hopefully we can refresh them. But this is basically on the other side, which when we speak to employers, and the respondents included more than 160 private sector companies, across various sectors like pharma, FMCG, manufacturing, IT, telecom, amongst others. And that's where we kind of get the other side in terms of what employers are thinking, in terms of the take up of the retirement benefits or the utilization and the appreciation of these benefits that are being provided. Of course, some are mandatory, statutory, have to be provided, and some others could be voluntary. Okay, so let me, without taking any more time on the introduction, let me just dive into some of the survey results. So before setting the Indian context, I thought it'll be good to bring out some sort of key themes which are emerging globally. And I think, Chairman, sir, you mentioned, of course, about increasing life expectancy, and of course, the need to find more savings. And actually, that's very true, and something that's you see globally already. So there's been a definite erosion of the retirement provision, and the easiest example, which I think, sir, you also mentioned, is about moving away from the defined benefit style plans to what we're calling defined contribution arrangements, right? So typically nothing is really guaranteed, for you in retirement, but you have to kind of build your own corpus, take some of those risks, and with that comes the investment risk, or the risk of potentially also the annuity rates which might move in the future, right? So a lot of that risk transfer has actually happened by virtue of this move from a defined benefit type arrangement where you're guaranteed a certain income once you retire, to a defined contribution arrangement where whilst companies or governments can be putting money on your behalf, essentially the risk of not having enough income still lies with the individual. And I think this is where I think the employers can actually take a little more responsibility, and we're seeing that as well, particularly during COVID times, when I think employers have gone the extra mile to educate their employees about the potential pros, cons, best practices or the smart things to do, especially when you're in a market linked retirement product. So just to give you an example, there is already the life cycle fund under the NPS, and the key idea is to reduce risk over time or reduce exposure to, let's say, volatility of investment returns over time. So we feel that a lot of these things which already the regulator has put in place to safeguard, but we also feel that employers can also potentially do a bit more, which we're already starting to see, to make sure the employees take advantage and basically choose or make choices which are in their best interest. And then last, I think individuals who are approaching retirement ages, what we also see is they're servicing larger levels of debt, with smaller proportion having housing wealth. Yeah. So what this means is basically that their financial commitments actually may not permit them to within inverted commas retire in the traditional sense of the word, and they're having to continue to find opportunities to work either with their current employers or elsewhere. So which basically means that people aren't really being able to retire even if they want to stop working, and that's something we'll probably continue to see unless we fix the issue of retirement adequacy, or people starting to put away money, ring-fenced money for their retirals. Now let's have a look at sort of what the subset in India was saying. So I'll start with the top side of the slide and I'll move downwards. So about 30% respondents actually felt that they were not heading in the right direction in relation to their overall financial position. This would include various aspects such as access to emergency funds or long-term savings to meet certain key life goals or milestones, and then of course retirement savings, and of course debt management. So in all, sort of roughly 1 in 3 felt that they were not heading in the right direction. Another 30% also felt that they were not heading in the right direction, specifically in relation to their retirement savings. Also, towards the lower half of the screen, you'll see that nearly 60% actually feel that they're not saving enough for retirement, and which of course links in with our broader finding that individuals are struggling to be able to retire at ages which people might have been retiring in the previous generations. Having said all of this, the silver lining in this seems to be that more than half of the individuals have also increased their allocation to retirement benefits savings in the last 2 years. Now it's a different issue as to what they might be considered enough or appropriate, but an increase is at least definitely a step in the right direction. I think in one of the subsequent slides I'll also talk to you about whether we feel what is adequate and what kind of minimum contributions might be deemed appropriate. Right. Also, if we, just carrying on from the previous slide, if you were to sort of divide all the 3 groups into, non-overlapping buckets, if we just said, okay, if we have 100 respondents, let me just slice them up. Roughly 30% felt that they're falling behind on the retirement savings, and also felt that they had not taken any steps to try and address the situation. For example, due to other more pressing financial commitments, which, like I said, could include things like debt repayment, children's education, and other potentially more pressing matters or more short-term expenses. More than 40% actually felt that they were on the right track, meaning that they were doing enough to work towards a comfortable retirement. These individuals could also actually be benefiting either from a lack of debt or presence because they have, already have inherited or have fixed assets such as housing, and therefore don't need to pay rent. And the final 30% actually felt that while they were not on track as yet, but they had recognized or taken cognizance of the issue and were actually trying to take proactive steps towards increasing their retirement savings. Possibly, the ways in which they might do it is again where companies have offered NPS as a voluntary top-up plans. Typically, you'll try and enroll in that, and then also you can also enhance your PF contributions by taking advantage of the VPF offering, which also a lot of companies now offer to their employees. Right. Okay. So now on this slide, quite a few numbers are going up. So let me first explain to you what I'm trying to do or what I'm trying to demonstrate through some of these sort of very basic calculations that we've done. And we'll try and work out, what might be an appropriate rate of saving or what might be an appropriate, quality or, income in retirement, and then work backwards from there to work out what might be an appropriate rate at which people can save for that end objective. So for this, what we'll do is we'll rely on a very old concept, very simple concept called the net replacement ratio. Very simply put, this figure just tells you, what percentage of your salary will you still be getting the moment you stop working or the day you retire, right? So what is your pension income expressed as a, as a stream of payments expressed as a percentage of your last drawn salary? To give you an example, if someone retires with a, let's say a monthly salary of 1 lakh rupees, and then, the day after that, they start receiving a monthly pension of 50,000. Very simply put, the net replacement ratio is roughly 50%. And also going by what we see from other countries, typically a replacement ratio and a lot of social security programs and a lot of benefits have been structured to target a net replacement ratio of about 50 to 70%. And therefore, we feel that that can be considered to be a sort of a good starting point. Of course, I'm not going to get into taxes. I know Ms. Kamden will talk about that later, but my example is just to give you an idea of what we feel, can be considered to be reasonable. Right. So the example, I basically consider somebody who enters the workforce at the age of 23 years and starts working with, let's say, a basic salary of 25,000 a month. Some of the other key assumptions, which I will not necessarily go into in a lot of detail, are at the bottom of the screen, but those are basically in relation to some of the returns that you can expect on certain investments. Right. So what happens is that if the individual only has the statutory benefits, i.e., just the PF and gratuity, and if all those proceeds that the person gets over their entire working lifetime, they take that lump sum and actually convert it to an annuity income, we feel they'll be able to achieve a net replacement ratio of about 34%. So which means that they'll only be able to get 1/3 of their last drawn salary as a regular pension income. And then also, if to this we add access to a superannuation fund, which typically contributes, or again, less popular now, but if let's say they had access to a superannuation fund, typically contributing at about 15% of basic salary, then this replacement ratio actually increases to 46%. And then finally adding NPS on top of that actually then bumps you up, into that sort of very respectable category of 63%. So finally, to conclude, while some of these outcomes, as you can see, at least, if you have access to all of these programs, they can be considered to be reasonable outcomes. But I think we need to keep a few things in mind. So one thing here is clearly that the person has started early, so at the age of 23, where very few people have historically at least thought about retirement plans, here this individual's actually gone ahead and, opted into NPS as well as superannuation right from day one. The other assumption is that the basic salary is actually a 50% of gross, which effectively means that the individual is saving 25% of gross to achieve a replacement ratio of 63%. Whereas in the market we see that typically basic salaries are much lower than 50%, but hopefully that will also get corrected as we talk about the wage code and some of these other legislations that are in the wings. And also the outcome is by no means guaranteed, because remember, this is a very simple deterministic outcome. There are going to be risks along the way. For example, an assumption here of, let's say, a salary growth assumption or a investment return assumption, there might be bumps along the way. But of course, in the long run, we expect them to converge to there, or at least be around that long-term mark. But just something that to point out that there are definitely risks involved on an individual basis. Right. So I hope that provides you a small peek into the financial requirements to be able to achieve retirement outcomes that can be deemed reasonable. But what is very clear is that simply providing the minimum statutory benefit, through the mandatory PF or the gratuity side may not be sufficient. Okay, so now let me look at this from the employer's point of view, and let's see, we've seen the employee side where, there are some sort of challenges, yet some recognition and appreciation, and also, what they probably need to do to get to a good place. Now let's see what the, what the employers are thinking about the retirement benefits. So here, this is the first slide that I've got, which talks about the prevalence of the corporate model of the NPS program, which basically means that corporates are offering this to their employees on a voluntary basis. So we're talking about purely the corporate sector, where typically, given that you already have PF as a mandatory benefit, an extra benefit of NPS is typically being offered as voluntary. But even that, we now see a lot of companies coming forward. I think Sir mentioned, and on every webinar, Sir, the number keeps going up, right? So I think this is the first time I'm hearing 9,000 corporates which are now offering it, which is great to see. Even our survey, the numbers we've seen are steadily increasing. So the survey, when we did it the last time, we had a number of about 43%. That's obviously jumped to 51, and I'm sure when we do the survey again in 21, that number will be even higher. And even those who've not actually implemented, you can see in the middle of the screen, there's another 20% of employers who are looking to roll this out, and do it, and give their employees at least the chance to opt in, even if they don't make membership mandatory at this stage. Right. Also, I think on this slide, you'll see the average take-up rate. I think, Mr. Chairman, you mentioned that, whilst a lot of companies have come forward and are offering this to their employees, we see quite a low number of employees actually, taking interest in participating. For whatever reason, I feel, they may have other struggles, or they may have other sort of short-term needs like debt or children's education, etc. And therefore the take-up rate is around that sort of 10 to 15% mark, especially for larger companies with young workforce. We find that that tends to hover around sort of the sub 10% mark. With sort of mature populations, you can we've actually seen more than 25% as well. So it varies quite a lot in terms of what the demographic profile of a company is, particular because of this plan being offered as voluntary. Also, just to add, on the left-hand side, of the screen, you can see that, there's a lot of flexibility being offered. So one of the suggestions that came out was, instead of just offering this at 10% of basic, can we not offer it, at various levels up to 10% of basic? So obviously that's encouraging people, or even the younger folks, to try and come forward, even if they don't opt in at the highest level, but start early. I think that's kind of just good practice. So even if you start, let's say, even with a small allocation towards your NPS investments, the trick is to start early. Then of course you can bump it up later. So that's that flexibility comes in quite handy as far as NPS is concerned. And also on the right-hand side of the screen, you can see that employers are also looking at ways of providing encouragement to their employees to engage with the NPS product. But again, we see that not a lot of them are willing to provide financial incentives, and the reason for that could be that this is an individual choice, and therefore we want employees to to engage with the product, and then but end of the day, this is their decision. So we don't want to provide too much incentive, because in case things don't work out as planned, we can have potential grievances from our employees. Right, and then just to sort of finish up on the NPS and some of the other developments that we see. So we know that there was a circular which came out quite a few years ago now, actually, where we have this allowance of moving or being able to move your legacy superannuation funds over to your corporate NPS account. So again, this is something that's starting to pick up, and I have no doubt that this will pick up even more, as we get a little more governance going for the superannuation funds. I think PFRDA, so Mr. Chairman, I think you folks are already looking at trying to get more visibility and get more good governance going on the superannuation funds, which obviously will now spark an interest in looking at how they're actually doing managing it. And one of the obvious things to do is to let people take that money to their NPS account. So as you can see, about 8% have already enabled porting of the superannuation funds to NPS, and 1/3 are actually looking at doing it soon. And we have at the moment we see a lot of interest in that space in terms of being able to expedite the sunset of superannuation funds, which are not as popular as they used to be at one point. Final couple of slides, we'll talk a little bit about the regulatory developments, because these are also going to have a knock-on effect on how employees and employers are thinking. So here we look at how employers are responding to the change in the recent overall limit of 7.5 lakh on the total employer contributions towards an individual retirement arrangement, which would include PF, SAF, as well as NPS. So given the 7.5 lakh limit is still pretty high, and a lot of these contributions are on basic salary, remember, these are not on gross. We find that a lot of respondents actually have said that they've currently not taken any steps in, considering any change. Whereas a few of them were looking at restructuring overall salaries, at least for the executives or the high earning parts of their population, to make sure that that tax limit did not kick in. But we suspect that a lot of this will also get picked up when companies start thinking about the impact of the wage code, which is actually my last slide. Because I think any retirement-based conversation is not complete without at least mentioning the fact that we are also in the middle of a fairly large overall when it comes to the labor code, and in particular, what impacts the retirals is going to be the code on wages, which was actually passed by Parliament as far back as 2019. And is currently in the process of being, notified, because we still are waiting for a date, which is actually causing a little bit of anxiety in the corporate sector, if I might add, because people are still grappling, and trying to understand what they need to do to be able to be compliant with that code, because some of the rules are still pending, at least at the state level, where we are waiting a little more clarity on these things. So right, I think just a few implications that could be there. Again, like I said, we still have to see the exact final, the final print, which hopefully will come later this year, if not, at least before the next financial year. So they'll need to review their overall compensation structure. For example, what they're going to use to be the new definition of wage, which will apply to their retirement programs. We also need to think about what components, for example, does variable pay also be included? Because, in the draft, at least we could see that, it refers to total remuneration and therefore is silent on how the treatment of variable pay is to be made. Obviously, if the salary increases, which is applicable to gratuity, then you'll find a higher gratuity payouts and higher liability. So that's something the employers need to consider, because that kind of, from the employee's perspective, it might be a good thing because, they get more allocated towards a long-term savings plan. But then, of course, somebody's got to pick up the bill, and therefore the employers need to consider that additional potential cost that will come through to them. The other thing also is about PF. So does PF contribution also need to increase, or can it remain linked to basic? And if it increases because of our Indian concept of a total cost to company, does that just then simply reduce the in-hand salary of these employees, which may not be the desire of the government, right? We want to allocate more towards retirals, or we want to use a heavier version of salary to create retirement provisions. But then if it's going to come at the cost of people having to make do with less, is that really the intention? So that's something that also needs to be looked at. And also, I think this is a pretty hot topic that we find, at least in the in the comp and ben kind of space, where now I think 75% actually responded to a pulse survey that we did, saying that they've already assessed the impact of a change in definition of wages on their retirement benefits, which means people have done their homework, but now they're waiting for the exact sort of fine print to emerge so that they can go ahead and implement some of these changes which are awaited. Right, so I'll stop here. Thank you again for your time, and I look forward to any questions later on in this session. So thank you so much, and I'll stop sharing my screen now.
Thank you, Mr. Banerjee. May I now invite Mr. Fukan? Yes, sir. Thank you so much, sir, for joining us today. And it's a pleasure to have you with us. Over to you, sir. We're just giving you the presentation rights. So the rights are given to you.
Yeah, I'm just sharing my screen. Is it visible now?
Yes, sir. It is visible. If it can be made into the presentation mode.
Yeah.
Thank you, sir.
Thank you. I'll just speak about NPS as a product and the features and benefits of NPS in the few slides that I have. And first and foremost, it has been said also that we have the pension account as a unique number. So it is transferable across employment, even if you're changing employers from government to private or between private also. And you can also maintain the account without an employer also. So this is what the uniqueness of the pension account is, that you need not close it if you are changing an employer. So the same number remains throughout the entire working life of an individual. So this is what we call as a unique PRAN, that is a permanent retirement account number that we issue to a person when he joins the scheme. NPS is one of the lowest cost pension scheme, not only in India, it's one of the lowest cost pension scheme globally also. And the cost of having this account or maintaining this account, whatever the charges are there, it comes to around 0.02% during the entire tenure of 35 to 40 years. Flexible choices are there, a lot of choices regarding the fund management options that are there. You can choose the fund managers. You have choices of different asset classes that you can choose. I'll speak about later about in the slides that I have. Returns are very much competitive. The fund managers have been able to generate and deliver returns for consistently over the last 12 years. And tax part, there are a lot of tax benefits on contributions. There are implications on tax at the exit also, which Madam Behrose will be elaborating and detailing in her presentation. Transparency and online, what we mean is that all the transactions that are there happening made by the customer or the subscriber is being transparently reflected in the statements. You can track your money flow. Your charges that are being debited to the person's account are also very much nominal, which are also transparently displayed. And over and above, the entire system is being regulated by Pfrda. We have different intermediaries or entities functioning, which operate on our guidelines and circulars that we issue from time to time. When we talk about this pension account or the PRAN, we have two types of account, the Tier 1 and the Tier 2, that is the nomenclature that we have given. But when we talk, the pension account is only the Tier 1 account, which is compulsory. This is what gets opened when you just open the or join the system. So there are tax benefits into this contributions and at the point of exits also. There are certain restrictions on withdrawal. It is not freely withdrawable. The minimum contribution for opening the account is 500 and annual contribution is only 1,000 rupees. But there are no limits on the number of transactions that you can make while contributing or on the amount. So according to your cash flows or the subscriber's cash flow or his ability to pay or the surplus cash he is holding, he can contribute any number of times, any amount during the year. The other account, which is optional, the subscriber can opt to open or not to open. And it is called a Tier 2, which doesn't have any tax benefits, but the only advantage is that freely withdrawable. And minimum amount required for opening the account is 1,000 rupees and 250 rupees subsequent contributions. So here also there is no limit on the number of contributions or the amount of contributions. This account is optional and freely withdrawable. And this doesn't have any tax benefit, but just for the viewer's sake, and this for government subscribers, central government subscribers, this Tier 2 has some tax benefits when they have lock in the contributions for 3 years. It's not available to the general public, only for the central government employees. We have a tax benefit to the central government employees. For joining the scheme, we have said that here the subscribers should fulfill the KYC requirements as per the PMLA. So that's what we require: an identity proof and an address proof, and he should be aged between 18 to 70 years. So this is the only basic requirements that are there, and he can be a resident Indian, he can be a non-resident and an overseas citizen also. And the account can be opened online through Aadhaar, PAN and bank account number verification, or the form can be submitted to one of our distribution points that we call as point of presence. And mostly all the banks, we have around 90 points of presence which are registered with us. So once the account has been opened, contributions can flow either from the subscriber alone, or he can type or have a understanding with the employer to contribute from both of the from the employer part also and so employee part. So when the employer also joins in, the contribution can be equal or unequal also. Or the employer can only make contributions, the employee may need not make also. So we have kept flexibility in the system that contributions can either flow from the employee or from the employer. And if they want to make both contributions, both of the employee and the employment, it can be in equal or unequal proportions also. So the flexibility has been built to receive any amount from either from the employer in any proportions. Once these contributions have been received in the system, it flows from our bankers to the fund managers of the choice the subscriber has made, which are again invested as per the investment guidelines that the regulator has prescribed. And at the end of the day, the fund managers declares the scheme NAV, the asset class which he has subscribed for. And on this NAV declaration, the contributions are again unitized by the record keeper, that is the CRA, Central Record Keeping Agency. And in the pension account, units are being reflected in the subscriber's account, in the pensions account. So what happens is that the NAV that has been declared by the fund manager and the units that have been reflected in the subscriber's bank account is the corpus. The units divided, multiplied by the NAV is the corpus that the subscriber would be having at the end of the day, and it varies on the daily basis. Once the contributions comes, those are again unitized and added up to the total units. So once the contributions are made, the corpus also grows over a period of time. Lastly, when we come about the maturity, once the contributions phase is over, we call it as an exit or a maturity phase. So normal exit, we call it as a superannuation age. The superannuation age may be different for different employers, and or otherwise it is 60 years. So what happens at the age of 60 or the maturity, when it's a normal exit that we call it in the terminology, 60% of the corpus outstanding at that point of time is paid as lump sum to the subscriber, and minimum 40% has to be annuitized, meaning that it has to be utilized for purchasing an annuity from a life insurance company, which are empaneled with us. And if the corpus is less than 5 lakhs, the total corpus, the entire corpus is paid as a lump sum. Whatever is not normal exit, we call as a premature exit. That is, you can close the scheme before the age of 60 or the superannuation, but there's a rider to it that you should be in the system for 10 years minimum. So in that case, 80% of the corpus is utilized for purchasing an annuity and only 20% is paid as lump sum. And if the corpus is less than or equal to 2.5 lakhs, the entire corpus is paid to the subscriber. And in case of death, the entire corpus is paid to the nominee, and the nominee also has a choice whether to take it as a lump sum or to purchase an annuity from the empaneled annuity service provider. So as I told you, the annuity service provider insurance company which are empaneled with us, 14 of them are empaneled with us, and they offer different annuity schemes with different varied or comparable distinguishable rates between them. And there are broadly 7 plans which all of them offer. One is with annuity for life, wherein the entire corpus, the amount that has been handed over to the insurance company is paid over the period of time to the subscriber till he is alive. And lastly, we have on the other end of the extreme is that whatever the amount has been handed over to the annuity service provider is being paid back to the subscriber or to his nominee once he is no more. So in this case, only the interest part is being paid and the capital is returned back. That is called the return of purchase price. And the variance between these two extreme products, wherein you don't get anything, and once you get where you get in the capital return, is almost around 30 to 35% of in the difference in the annuity. As I told you, a lot of flexible choices are there. First choice is about the record keeper. We have 3 record keepers. 2 of them are operational. One's CAMS, which has been recently given registration, is yet to start operations. And this is the first choice has to be made. This can be also been exercised by the distributor because he can tie up with any one of them or all the 3 of them also. So choice gets restricted according to the point of presence also. So next choice is about the pension funds. We have 7 fund managers which are sponsored by bankers, AMCs and insurance companies, which are exclusive companies established with us to manage only the pension corpus or the NPS corpus. And any one has to be chosen by the subscriber. And this choice can be changed once in a year. Next, coming back, how the contributions are being allocated, it depends on the choice of the subscriber also. So we offer 4 asset classes, that is equity, corporate bonds, government securities, and alternate assets. And we have put limits on equity and alternate assets. So the contributions can be allocated across all 4 assets classes with 100% in corporate bonds or 100% in government securities. But we have said that the maximum percentage of contribution that can go into equity is only 75% and alternate assets only 5%. And this choice can be changed over. Sharing one application is there. I hope my screen is visible.
Yes, we can see.
Yes,
We can see the screen asset allocation.
Okay, fine. So what happens is that the asset allocation, the 5% only we allow to for all alternate assets because these are presumed to be riskier assets, and this is called an active choice where the subscriber actively chooses among the 4 asset classes. The next choice is about the auto choice that we call is a passive choice. One second, I'm just not able to change my screen. Just I'll reshare it once. So next choice is auto choice, where the allocation between the 3 asset classes, equity, corporate bond, and government securities, is predetermined. So we have 3 LC75, which is an aggressive fund. It means nothing that the equity exposure or the allocation is 75%, 10% to corporate bond, and 15% to government securities. And we have a conservative one, the equity exposure is 25%, and a moderate one where the equity exposure is 50%. And the beauty of this is that up to 35 years, this asset allocation remains constant, and after each passing birth date of the subscriber, that is from 36th birthday, the equity exposure goes on reducing till the age of 55. So what happens is that in an aggressive fund, that is 75% equity, on every year it reduces by 4%. In the moderate one, it reduces by 2%, and in the conservative, the LC25, it reduces by 1%. So at the end of 50 years, what happens is that you have an equity exposure of 15% in the aggressive one, 10% in the moderate one, and 5% in the conservative one. So this is auto rebalancing happens on each birth date of the subscriber without the subscriber giving any specific instruction. The system takes care of it automatically, and this allocation can also be changed twice in a year between active auto or between the auto also from moving from one life cycle fund to another life cycle fund. Next, I'll just brush on the returns. This has been told about that we have been able to deliver quite competitive returns over the track record of 12 years, and we have a 13-year track record in a composite scheme, where the central government scheme, which was one of the oldest, and where we have a equity exposure of around 13-14%, and corporate bonds of 38%, and 50% in government security. So we have a 9.91% in the central government or 9.8% in the state government. This is a composite, and this are similar schemes. And equity, we have been able to deliver around 12.72%, corporate bonds almost around 10%, and GSEC around 9.5%. This is the snapshot of the corpus that is regulated by PFRDA, 4.4 crores of subscribers. Central government and state government around 75 lakh subscribers. In the non-government, where we call about the corporate and the all-citizen model, or the individuals who join voluntarily the scheme, it's around 29.5 lakhs subscribers. NPS Life, which has been a discontinued government scheme, that's around 43 lakh subscribers, and APY, we have almost around 3 crores of subscribers, which is also a government-sponsored scheme. So on the corpus, we manage around 6 lakhs 26,000 crores, of which 5 lakh 10,000 crores belongs to the government subscribers. Around 95,000 crores belongs to the corporates and the voluntary subscribers, and around 22,000 crores for the government-sponsored schemes. When we talk about transparency, we thought that the transactions are visible. Yes, we have enabled a web login. The subscriber can log into his account anytime. And we have a mobile app also. It depends on which record keeper the subscriber is tagged to. So we have 2 record keepers right now functioning, NSDL and KFintech. So they have different mobile apps, and from this apps and the web login also, after login, a subscriber can transact online, like contributions, withdrawal requests, changing of bank account, everything can be done. Nominee change also can be done. Lastly, I just want to touch upon the grievance redressal system that we have established. We have a special regulation for that to address any subscriber grievances in the system. So we have established a mechanism of escalations also. So we see that it is being resolved within a definite timeline. The escalation matrix is that the subscriber, if he has grievances, it goes to the entity against which, because we have a lot of intermediaries in our system. So that should be resolved within a period of 30 days. And if it's not being resolved, or the resolution provided, the subscriber is not satisfied with the resolution provided, it goes to NPS Trust. And after that, if it's again escalated to the ombudsman, after that, it can come up to the authority. And then if it's not satisfied with the authority's resolution, it can be appealed at the Securities Appellate Tribunal. But we have not got anything like that until date to be escalated beyond us. Thank you, and over to Shri.
Thank you so much, sir, for an excellent insight into the scheme. May I now invite Ms. Kamden, please?
Yes, thank you. Thank you, Mr. Bandyopadhyay, for giving this opportunity to us to discuss on NPS tax benefits. Thank you, Mr. Mitra, for inviting us for the session. And it was a pleasure listening to Banerjee and Mono. Mono, can you please share the presentation? So we have a small presentation on tax, and Mono, congratulations for the promotion. Basically, NPS, I think all of them have spoken on a lot of benefits that are there for NPS. And personally, if you look at me, I think it has certain benefits which were not there in the earlier pension funds which are there in India. So the one key thing which I could find most beneficial was that it's portable. It is not linked to one employer. When I move employment, I can move my NPS account with that employer, with the new employer. And that I think is the most important, because I served an organization in the earlier start when I did it for 8 years, and I was eligible for pension if I have completed 10 years. And since I left after 8 years, I had a sabbatical, and I don't think I'm eligible for pension any longer, though I started working after joining back. So you lose out on pension in the old schemes, which you don't lose out on NPS. The second most important thing which I found good in NPS was that most of my family are from bankers. They have worked in public sector banks or banks, and they are all eligible for it, or the army where you're eligible for pension. I'm the only one who doesn't have pension. So for me to have a pension, NPS is very useful. And second thing, what I saw in banks, that the older case which Mr. Bandyopadhyay referred to, saying a defined benefit plan. A defined benefit plan gives you a fixed amount every year. That amount is big when the pension starts. But over the years, in 20 years time or 30 years time, that amount is not actually material. While if in case of NPS, 60% of it I can withdraw, 40% only goes into compulsory annuity. So what gets fixed is the 40% of my corpus. 60% of my corpus is with me, which I can invest and I can earn accordingly. So in that sense of the thing, my defined contribution, the amount that I keep contributing will of course grow the corpus larger. So the amount that I receive as pension increases. And Banerjee did mention that it's so important to have a larger corpus. Just one of the retirement benefits will not help us when we need the pension. So having a larger corpus will help. And further, out of that also, if I can take 60% on maturity and then invest according to what will give us good returns, it would be very helpful. Can I request someone to share the presentation? Okay, thanks, Mono. So basically today we will be talking on the tax benefits and of course the returns. And I think this is also very important to understand. See, generally we have a little apprehension as to whether we would be good fund managers to manage our own funds. And therefore, if you're not so good or we don't have the time, we invest in mutual funds or we invest with government authorities or invest with banks because they will do the investment and give us a fixed return. So we're very happy with a fixed return coming to us to say, okay, I know this is my return which will come to us. In NPS, I can look at the fund managers, how they are doing. I can keep changing the fund managers if they're not performing well. So, and secondly, if I don't have time to do all that, I can just invest in government securities. I mean, for an individual to invest in government securities now, I think government is coming out with those platforms where retail can invest in government securities. Earlier, it was not feasible. So this was a very good scheme to say, I just put in my money in government securities and it's giving good return and I know it and I can view it and I can change fund managers if they're not performing well. At least that thing is right is with me to change fund managers. And that's very important for us. So I think NPS does have a lot of advantages as compared to other traditional pension fund schemes which are there. But like Bandyopadhyay and others have mentioned, we can't rely only on one scheme. You need to look at the entire spectrum of investments and also have a national pension scheme. And I have myself opened it because my son said everyone's going to get pension after retirement and I'm not going to. So I said, I better have something which gives me pension at retirement. So NPS is good because an individual also can open an account. Now, when we look at tax incentives and NPS, and we will also discuss what the finance bill changes have been, Finance Act 2020 and the Finance Act 2021. Now, when we look at the income tax incentives for any scheme, any investment for that matter, we see whether the government is giving me some benefit by investing. So is my saving going to save my tax also? So that's first thing that we look at. Then if it's an employer-employee scheme, what we look at to say is that, will the employer get a deduction for it if he's going to contribute something? Will the employer's contribution be taxable for the employee? And if the employee also is going to contribute, will they get a deduction? The second part is when the scheme is growing. So during the tenure of the plan, what is the income tax implications of it when the plan is underway? Third is when I'm going to withdraw. If I'm going to withdraw, on withdrawal, is it going to be taxable or not taxable? So everyone keeps talking about public provident fund. They say public provident fund is like an EEE, that is exempt, exempt, exempt. So when I contribute to public provident fund, I get a tax benefit under 80C. If it's within that limit, of course, it has to be within that limit, but I get an exemption. So if I have provident fund, if I have insurance, I have public provident fund, then that limit may be exhausted also. But it's on investment, I get a deduction. Then throughout the years that I'm saving on PPF, it is not taxable. The interest income is not taxable. So again, it's exempt. And on withdrawal, it is not taxable. So again, it's exempt. So they always compare saying that PPF is exempt, exempt, exempt. Is NPS equivalent to exempt, exempt, exempt? And I think the PFRD has done a very good job. They've actually got a lot of benefits, tax benefits, and additional tax benefits as compared to PPF also. So when we look at an NPS, when I'm investing into an NPS, the contribution that I make, do I get a deduction for it? So there is a deduction which is covered within the overall limit, plus there's an additional deduction also, which we'll talk about. Throughout the years when I'm investing, is the amount what I accrue, is that taxable? Employees' contribution, not taxable. Individual contribution, not taxable. Employer's contribution, taxable, which we'll discuss, only if it exceeds a particular limit. And then on withdrawal, 40% annuity has to be taken mandatorily, which is not taxable. And 60% what you receive is also not taxable under Section 10. We will discuss these tax incentives more in details, but just to give a point that NPS also now is nearly an EEE account. So it's exempt, exempt, exempt in that manner. So if you go to the next slide. So contribution by the employee. So when an employee contributes to NPS, you get a deduction, which is restricted to 10% of your salary plus dearance allowance. And if it's an individual like me or someone who's not an employee, an individual account, then you get 20% of your gross income. Up to that is the limit which is there. And that overall contribution goes in the overall limit of 1,50,000. So it is clubbed along with 80C, 80CCC, 80CCD1. All of that should not exceed 1,50,000. But then they have given additional 50,000 deduction only for NPS. So if I'm in the highest slab bracket, I can get immediately a benefit of around 18,000 if I invest 50,000 rupees. But like we say, tax should not be the reason for investment. Tax should be, of course, looked at, because I always look at my net of tax. What is my cash flow? Kitna paisa mujhe milega? It's very important. I have to know what is my return. And my return can only be net of cash, net of tax, which is there. So when I'm looking at my return net of tax, I will look at it. But tax should not be a reason for making investments. Though our government over years have, encouraged people to save by giving tax benefits, but that should not be the only thing. You have to look at your risk. You should get your money back. That's the main thing. So look at your risk, look at the returns, and then look at the tax benefits. But here in NPS, you get an additional benefit of 50,000 by just investing around 50,000 plus. And if you're in the highest bracket, it's good. However, government has now come out with two schemes of taxation. One is a normal rate of taxation, which applies to most all individuals. Another is a lower rate of tax, which has been provided, subject to you giving up all the exemptions and deductions that you claim. So when we looked at it, it appeared that this would really benefit the lower income people, or the people who don't have the ability to save. But people who have the ability to save and are in the higher income brackets, it is better to go on a normal rate of tax. But of course, you need to do that exercise individually and then see what is beneficial to you. However, if you opt for the lower rate of tax, then you don't get this additional deduction of 50,000. You don't get any deductions. 80C also you don't get, PPF and all that also you don't get. And you also don't get deduction for NPS. Now, when you look at the employer's contribution, employer's contribution to NPS is fully taxable. That's given under salary itself to say it is fully taxable. It is part of salary. And they also say that if it's exceeding 7,50,000, so what they have done, they have put in two conditions for employer's contribution. One, to say the amount is fully taxable, but I get a deduction for it under 80CCD, full deduction. Subject to it does not exceed 10% of the salary in case of employees. And in case of central government employees, it should not exceed 14% of salary. So if an employer contributes up to the extent of 10% in case of normal employers and central government up to 14%, then the entire amount is not taxable because you added a salary and you get a deduction for it. So there's no change. But the employer's contribution now will be taken to compute the limit of 7,50,000. And we'll discuss that a little later as to how that limit is computed. And this employer's contribution will be allowed as a deduction irrespective of whether you opt for lower rate or you got a normal rate of tax. So that is one thing which is very good, that anything that employer contributes within the limits of 10 and 14% is fully allowable as a deduction. And of course, employer also gets a deduction for the contribution that it makes. So the employer gets his own deduction. Employee is not taxed on the employer's contribution only if it doesn't exceed 7,50,000. If it exceeds 7,50,000, then there's some tax on it. Annual accretion to NPS, again, annual accretion which an individual does or an employee does is not taxable. Annual accretion of the employer to the extent it exceeds the 7,50,000 is taxable, which is the change which they brought in by the Finance Act of 2020 and 2021. So annual accretion per se is not taxable except if it exceeds 7,50,000 only in case of employer's contribution. Withdrawal from the fund, like we mentioned earlier, withdrawal from the fund, 40% is compulsory annuity, which is not taxable. 60% is exempt under Section 10, so 100% is not taxable on maturity. Now, when you do partial withdrawal from the fund, which also is allowed during the life of the fund itself, there is a little, I think, maybe not intended, but it says 25% of the total amount payable to an employee is exempt from his contribution. So whatever employee's contribution has been done, up to 25% of that contribution, what is there, is exempt. But the words use employee. So if an individual like I were to contribute, and if I were to withdraw in between, then my entire withdrawal will become taxable. So partial withdrawals which happen for other than employees, there's no exemption. And I think this may not be the intention at all, because it's my own amount which I've contributed, at least some part of it because of emergencies. The partial withdrawals are only in case of emergencies. So if there are emergency withdrawals to be done, then that should, at least some part should be exempt. Contribution tier 2 account, like Mono mentioned, this benefit has been given only to central government employees, because otherwise a tier 2 account is like my normal mutual fund account. But it has little advantages. If you compare the return of a tier 2 account as compared to a mutual fund account, there are few advantages. One, because the cost is low, which is charged on it. Second, certain securities transaction tax and all of that, which applies to normal mutual fund, doesn't apply to a NPS. So when NPS makes investments, they don't have to pay all those things. While a mutual fund, when they make investments, they'll have to pay. So my return is going to be a little higher in a tier 2 as compared to a normal mutual fund. And it acts like a normal mutual fund itself. So the tax also is the same as a normal mutual fund. Central government will get a benefit if they contribute under 80C. That is similar to what your PF, PPF and all those contributions are, within the overall limit of 1,50,000. But this is a benefit which they have given. So if you don't have a PPF account, you could have a tier 2 account. And you could get a benefit on up to 1,50,000. Next slide, please. So this is a change which has happened in the Finance Act 2020. See, earlier what used to happen is employers' contributions used to not be taxable, except for Superannuation Fund. Superannuation Fund, there was a limit of 1,50,000. Up to 1,50,000, if you contributed, the employer contributed, it was not taxable. Over and above 1,50,000, it used to be taxable for the employee as salary. Provident Fund also had the same thing. You contribute up to 12% of basic salary, it is not taxable. Anything above 12% was taxable as per that Schedule 4, which is the end of Income Tax Act. And employers' contribution, though it was taxable for NPS, used to get a full deduction under 80CCD. Now they've gone and amended the definition of perquisite to say that the amount of contribution to an approved superannuation fund, to a recognized provident fund, and to a scheme under 80CCD, which is NPS, all of that you aggregate together, and if it exceeds 7,50,000, then the excess is taxable. And this is with effect from assessment year 21-22, which come into effect from 1st April 21. That means from last year itself, financial year April 20 to March 21, this was already effective. So anything in excess of 7,50,000 was taxable. And when we really did an exercise based on some publicly available database, it was not impacting a lot of people. There are very few people who really contributed over and above 7,50,000 as compared to the large population that we have. The second amendment they did was the annual accretion of interest, dividend, or any other amount of similar nature during the previous year to the balance of the credit of the fund, to the extent that it relates to this excess of over 7,50,000 will be taxable. So up to 7,50,000, the annual accretion is not taxable. Anything that you contribute in excess, so if you contribute 8 lakhs, then on the 50,000, whatever your annual accretion is there, that will become taxable. And they said that they will come with the rules for it. So they have issued the rules now. If you go to the next slide. And very detailed rules. A lot of thinking was gone into it. I think a very detailed rule they have come out with. The only thing is they could have actually just prescribed a particular rate of return instead of doing a working for it, because that complicates the matter a little bit. In case of salary, I need to start withholding tax from the first month itself, taking an estimate, and then I keep correcting it over the months. But here, something that they have asked for can be known only at the end of the year. So then there is going to be some difference in my perquisite value for the year and which comes at the end of the year. And I think they could have just avoided this whole complication. So the section 72 says that, and they say during the previous year, which is the current previous year, and how they've come out with the formula is very good. The taxable perquisite will be equal to whatever amount you pay, the principal contribution which you do, PC, upon 2, because they want to average it out for the year. So irrespective of whether you contribute more in the first months or the end months, they want to average it out. So whatever principal contributions you do, divide by 2 into R, and that's the rate of return, what they expect to come. Plus whatever was the principal contribution which was taxable in the earlier year, and whatever was taxable in the earlier year into R. So this is a cumulative formula which has to be applied. And it's a very simple formula, actually eased out. So we had a lot of questions to say, how will I do my FIFO, which will be taken as, first 7,50,000. They said you aggregate everything. All 3 you aggregate and you find out whatever it is. And that's what the formula also says. The only thing is in the average, if you look at the rate of return, R is amount of aggregate amounts of income accrued during the year. You take the total income accrued during the year and you divide by the amount of balance or credit at the first day of the previous year and the last day of the previous year, divide by 2. So that's last day of the previous year will not be known during this year. And that's the whole issue, that I'm going to take some estimated figure and then work out my perquisite. They could have just done it differently. They could have just given a rate, maybe, because it's only a perquisite value. Whichever the rate prevailing around, average rate, they could have taken and given. Or they could have taken the earlier years. If they had to take it, they could have taken the earlier year's rate and done it. But this is the working which has been prescribed in the rule, and this has to be adhered to. So there will be some change which will keep happening during the year, and the end of the year, the employers need to look at it. Next slide, please. This is only, we've given some illustrations, you can go through it, but just to give an example as to how the working will be done, we've just given an example for last year and the current year. Last year, anyway, no interest was credited because the excess was only computed at the end of the year, and from 1st April, this rule has come in. So last year was only the excess amount which was there, and there was nothing, no assuming that there was no contribution of interest being done to PF or superannuation at that point of time. All the accrual interest, annual accrual interest will come for the current year itself. The next slide is the current year. If you go to the next slide, please. So it's just an example that we have given as to how we have to take how you need to work out the formula. It's a very simple formula. They've tried to do it very well. It's a very simple formula. The only issue which comes in is for the return, the R, because that may keep changing. And we may have to take some estimates in the initial years as compared to the end of the year. So that's the only thing which is there, but otherwise the formula is very simple. And if there are any questions on this, we would be happy to address it. So thank you. Over to you.
Thank you, ma'am. Thank you, ma'am. Mr. Mitra, would you want to actually take up the question answers?
Yes, I can.
Can you see? I think we have the questions in the chat box.
Just a second. Yeah. I'm unable to see any question in the chat box as of now from the participant. Is there a question from any participant?
There are a couple of questions that have come in. One moment. Chairman, sir, can we actually direct the questions to you, please?
Yeah, sure.
Thank you, sir. So I think a couple of them are, I think, very basic questions. What is the upper age limit to continue the NPS contribution? Are there any documents required that needs to be filed after 60 years? Is the first question. There is a question from Mr. Vinod Parameswaran asking, is there any difference in asset allocation or return for amounts invested in Tier 1 and 2 in NPS? These are like 2 questions that have come in. I think there are a few more questions that are there. So if you can please help, sir. Would you want me to read out the rest of it, or we take one after another? How would you feel?
I'll take these 2 questions first, and thereafter, whatever questions are there in the chat box, that we can answer one after the other. The first question, if I correctly heard, is that how long a person continue under the NPS system. Actually, earlier it was up to 70 years. Now we have extended it to 75 years, looking again into the longevity issues. So a person joining NPS can really continue up to the age of 75 years. Of course, this is an enablement. If the person wants to close that immediately after 60, fine. And thereafter also, once he or she continues after 60, there is no such compulsion that they have to continue necessarily up to 75. In between, any time they can close and go. And the second question was regarding the...
Sir, the question was, is there any difference in asset allocation or return?
Asset allocation, that is also a very nice question. Yes, you can have different asset allocations for 2 different tiers. Tier 1, you can have one kind of asset allocation, and in Tier 2, you can have a different kind of asset allocation. So, and since Tier 2 is optional, so obviously many people, they choose a different asset allocation for Tier 2 so that they can also generate their corpus in a better way. And of course, Tier 2 is withdrawable at any point of time, and looking into the risk appetite and all that, they can choose their asset allocations accordingly. So there can be two different asset allocations, and all of us present here, including myself, we have as a Tier 1 and Tier 2, and Tier 2 asset allocation is definitely different.
So there's another question that's come in. This is from Mr. Kotishwar Rao. How many years the dependent nominee can get the pension? Until what age will he be eligible for it? Is one of the questions. He has another question which he asked earlier. One moment, sir. If a person dies while in service, what will the pension amount and the calculation? How many people can get the pension is the other question that he had. It's from the same. We have, I think, about 25 odd members who have joined on one link. So I think the questions are coming in a bit slow. So I just wanted to flag that, sir.
Okay, I'll check. Okay, one is that how long the nominee can get the pension. So it all depends on at initial stage what kind of annuity that the person has chosen. Normally, the kinds of annuity it is chosen is we see the person gets annuity throughout the lifetime. Post his or her death, it goes to the nominee, and normally nominees are spouses respective. And then the nominee continues to get for his or her lifetime. And obviously thereafter the entire corpus is returned to the legal heir. So if this kind of annuity is chosen, obviously the nominee also will continue to get pension till his or her lifetime. And that is the safest option, and most of our people who are retiring and exiting the system, we see that they are choosing this option. And secondly, I believe it was if there is a death when the person is still working. So for other than government, we have allowed that you can withdraw the entire corpus if you wish. But if the nominee wants to take a pension, the pension can be given. The annuity can be given according to their choice. So both the options are open for non-government. Of course, for government, we are not discussing that here because here actually, I believe we are addressing the corporates. So
yes, sir. Okay, sir. Sir, there's a question from Mr. Neil Castellino. Presently, there is a taxation on exit, which is planned in the near future. Is the government considering to exempt it similarly like EPF and make it an EEE scheme is what he has mentioned?
I believe Madam Barrows, when she was giving her presentation, she made it very clear, and I also want to make it very clear. Currently on exit, there is no tax. Please understand that what we are trying to say here is that 60% we are only allowing to withdraw, which is tax-free, and 40% we are not giving in your hand. We are necessarily asking the person to take an annuity. Suppose you take a 100% tax-free return from PPA. What are you going to do with the money? Ultimately, the money is going to be invested somewhere. And even if you keep it in your savings bank account also has a limit beyond which if you earn interest, that is also taxable. So whatever comes out of the tax-free income, that is taxable. The return that comes out of that tax-free income. So ultimately, even the NPS money, the entire 100% is tax-free. 60% I am giving in your hand tax-free, and 40% I am transferring as an annuity. And in the process of the transfer, also no tax is involved. What annuity comes back, that annuity income is taxable. Like your PPF money, suppose you invest in a fixed deposit, that fixed deposit earnings will be taxable ultimately. And there will be a TDS if you are beyond the income tax exemption limits. So okay. I think I can take a confirmation from Barrows Madam. What I said is correct, Madam, or you have something to add?
No, absolutely, Mr. Bandyopadhyay. Absolutely correct. I think on exit, it is tax-free. So 60% is tax-free and 40% again, what you take annuity is tax-free. What you receive annuity after taking the annuity policy, that is taxable. And that is taxable
So
even otherwise,
actually,
like what Mr. Bandyopadhyay mentioned, that is taxable even otherwise. If you were to put in fixed deposit, you would have still paid tax on the interest. Or you would have taken a mutual fund, whatever income you get from mutual fund, you would have still paid tax on it, including dividends, interest, everything is taxable. So an annuity also is taxable.
so actually it is an optical illusion. I am
Yes.
telling 60% is tax-free, but with the tax-free amount, suppose somebody has a corpus of 50 lakh, so 60% becomes 30 lakh. 30 lakh, nobody is going to spend now overnight. They definitely will invest it somewhere, so that even the tax-free income of 60% will generate the income which is taxable.
Yes. Yes. And if you compare this with a mutual fund, so assuming if you take a mutual fund and you keep for 15 years, after 15 years, when you withdraw from mutual fund, it is going to be taxable. It's going to be a long-term capital gain, maybe tax at 10% rate, but it will still be taxable. Well, here when you put in for 20, 15 years or 30 years or 40 years, whatever you receive on maturity is not taxable, but what you invest, so when you buy the annuity policy, whatever annuity you receive is taxable fully. So in that sense, it is there. There's one more question which has come privately to me. Can I just take it along with this?
Yeah.
Please.
It is asking what is the tax impact on profit on tier 2 withdrawal?
Yeah.
So like we mentioned, tier 2 withdrawal is mainly like a mutual fund investment. It is not a sort of a pension this. So whenever you withdraw from a tier 2 account, it will be taxable. You have to see whether it's long-term held or short-term. And you'll have to pay capital gains tax on it. So long-term will be at 10% and short-term will be a normal rate of tax. So the withdrawal from tier 2 should be taxable. Mr. Bandyopadhyay would like to add something here?
No, absolutely. I believe that is fine. That is, and a lot of people want to ask that what about tax treatment on tier 2? So I believe you have given the absolutely right answer.
Thank you. So this was the two questions which
There's another question. If we have time, sir, may I continue?
Yeah.
Questions. Yeah. So there's this question that's come from Mr. Mazumdar. Minimum contribution in tier 1 is ₹1,000 by individuals. In case there is no contribution in tier 1 in any particular year, what will happen? Will it become inactive, subsequently revived, reactivated? If yes, what is the procedure? Is one of the questions that's come in. May I take in another question if that's okay? I think.
Yeah, it becomes inactive, I believe, for 1 full year if somebody does not pay.
Yes,
but yes, that account continues and you can reactivate it. I request Mr. Fukan to tell the process for reactivation.
In fact, 1,000 rupees is not being deposited. It becomes temporarily inactive in the sense that he cannot do any changes in the account on his personal details. But once he starts contributing, it reactivates on its own. So there is not a procedure to reactivate the account. It's only the contribution will reactivate it. The inactivity will be there. Inactive status will be there only for changing of personal details included once the 1,000 rupees is not being contributed.
And maybe somebody may be concerned that whether there will be a fee or a fine or something like that. Absolutely nothing. Absolutely nothing.
Sir, I think a couple of questions that had come in.
Yeah. We are.
I think when we had announced the meeting, why can't NPS provide a deferred annuity option by fixing some minimum annuity amount so the subscribers can buy annuity on an ongoing basis is the question. Start from the age of 58. So this is one of the questions that come in. Would you want to respond to that, sir?
It's very interesting that somebody is thinking in that line, and I'm very happy. And definitely we'll look into the proposal. But today, what happens that exit was taken as 60. So what we have done, we have provided a deferred annuity option at the age of 60. A person can defer his or her annuity by 3 years. That option is already there. What this person gentleman is asking for is maybe whether we can prepone it by 2 years, and from 58 itself, I can ask for a deferred annuity. But in deferred annuity, there are deferred annuities. What happens? See, if you are there going to buy a deferred annuity with an insurance company at that point of time, One is that you have to give the corpus to the insurance company so that they can utilize it to their benefit. And there are annuity products where if you defer it by say 10 years, you get more than 20-25% in the annuity rate. Obviously, because the insurance company has enjoyed that money for 10 years, so obviously they are ready to give you higher annuity rates. So if the current annuity rates are say 6%, obviously it will go up to say maybe 7.5% if you defer it by 10 years. And if you are willing and in a position to defer it. So these kind of things are there. So we are looking into all these options, but what he has said that whether at 58 also we can look at it, definitely we can look into that option. And I can tell you NPS is possibly the most flexible product retirement benefit solution available in India today. The kind of flexibilities we have given, 60 years to defer annuity by 3 years, even that 60% withdrawal, you can take it over 10 installments. It may not be equal installments also. Now we are going to increase it to 15 years because now the exit age is also increased to 75 years. So over a period of time, it normally actually stands as a systematic withdrawal plan. You can plan your withdrawal over a period of time, not that immediately. Many people, many contributor will not be in a situation where they need that 60% immediately. No, that also can be done.
I think you've answered Mr. Murali's question. Mr. Murali, I think your question on is partial withdrawal permitted after reaching 60 years of age, I think sir has answered through this particular response. There's one question from Mr. Thirumalai. Can the balance in the superannuation account at the time of retirement be transferred to NPS account? This is post-retirement.
You have to time it accordingly. Just before 60, you have to do it. So on the last day, if you wish to do it, obviously it will fall foul of the system. So just before that, and a lot of people are using this benefit because in the normal superannuation funds, as I said, only 1/3 withdrawal is tax-free. Commutation is limited to 1/3, and that is only tax-free. So many people just 1 year or maybe 6 months before retirement, they transfer their entire corpus from their approved superannuation fund to NPS and get that 60% withdrawal benefit. Yes, it is happening. But we want them to remain invested up to 75. That will be our interest.
I get that. So I think Mr. Thirumalai has one more question. I'm sorry, I'm taking I think a little bit more time, Mr. Mitra. Just a moment. If yes, whether the superannuation deeds need to have such a provision, specific provision. I think it's asking specific to retirement balance being so, and that's a continuation of his previous question, sir.
Continuation of
his previous Mr. Thirumalai's question on superannuation account, moving the balance of the superannuation account, then whether the superannuation deeds need to have such specific provision. He's coming from the aspect of anything that needs to come from any provisions need to be made specifically for that. I think you answered it by saying that he has to do it one day.
Yes.
I think so. That's taken
care.
Yeah,
I think it's answered. It's answered. Yeah.
Yeah, and there's one last.
Can I just add here? Sorry, can I just add here? I think what the question was is whether my superannuation deeds. So some of the superannuation deeds allow for withdrawal before maturity. Some don't allow for withdrawal. Some don't allow transfer to another fund. It is to be given to the employee. So your individual superannuation deeds have to be looked into. And maybe Banerjee can add over here. But I think most of times, I think the superannuation deeds are very differently worded. So you will have to look at your superannuation deed before you make a transfer. And it's better you do it as an employee, not as post-retirement, because then the tax also is a consequence.
Yes.
Hey, if I can just add, so yeah, absolutely right. So I think we've assisted several of our clients do this. It's actually fairly straightforward, but what you have to do is you'll have to add a deed of variation with this reference to the PFRDA circular. And then once that is approved by the local income tax, the local sort of commissioner of income tax, then you can actually start the process of actually individually paying out. There's a standard guidance note, I think, which Sir PFRD has already put out in terms of the steps to be followed. But in terms of the deed itself, it's a very simple deed of variation which needs to be drafted and approved by the CIT.
And I think there was one question that came in earlier. Is it a group scheme or individual schemes, as this pension component is part of CTC, but fully contributed by employee? I think this has come as one of the queries that had come in earlier. How NPS is advantageous over conventional superannuation scheme, LIC? Or will there be a probability, I think, portability option? I think these were questions that were answered during the presentation.
Yeah, yes.
Yeah.
Yeah, I think Suranjan can add to it, because they are going to advise different clients on which kind of schemes they should go for. So if Suranjan can.
Yeah, I can make. So I mean, sir, if I've understood the question correctly, it's how does NPS compare with the erstwhile superannuation funds, right?
That's good. Yes.
Yeah. So maybe I'll just make 2 or 3 really quick points. I think first of all, the biggest problem that our clients seem to be grappling with when as far as the superannuation fund is concerned is a lack of portability, right? So the issue there is that even though individuals may have left in the company after having a certain number of years, but you've not settled those balances because like Beroz ma'am was saying, there are clauses or the rules dictate that you can only either start an early pension, but for that also sometimes members have to turn at least 50, 55, or you can only transfer to another approved superannuation fund, right? And there are not that many. I mean, nobody's opening new superannuation funds, so it's very difficult to take that money with the individual. And by the time you go and look for them, their phone numbers have changed, their addresses have changed, and you kind of stuck with this money which you're holding as a company under a trust, and the individual you cannot find. So you kind of it's a double whammy. The individual is not getting what they were promised, and you're left holding the money and having to spend on governance and ongoing audits and stuff like that. So that's the biggest one. Apart from that, I'll maybe make 2 or 3 really quick ones. So one, I think I mentioned during the presentation, NPS is quite flexible, so you don't have to keep contributing at 10%. You can it's basically between the company and an employee. You can opt in at 5%, you can go up to 10%, you can stop for a while if you want. Whereas SAF, because it's all black and white, you either opt in at 15 or any other number which is in the rules. It's not something that is just between the two the two parties, because there's the income tax approval which sits on top of that. So any changes have to be approved. And then I think just investment options are far more. So, you can have your own investment strategy, you can have your own fund manager, you can have your own annuity service provider under the NPS, whereas under the SAF, these are all very tightly linked. We find little disclosure. So, you may get one statement once a year saying, what is your balance, whereas in NPS, it's all real time. You can log in anytime, make changes and all of that. And then finally, the form of payment. So here you're getting 60% as cash at the end. Whereas under superannuation, you can only get 1/3 as cash. So here there's again more flexibility to do what you want with your retirement corpus. So just those 3 or 4 points, and I think that's where I think the industry and the market is moving away from superan towards NPS.
NPS.
Thank you for taking that question and making my job easier. Because it was literally comparing the benefits given by my previous employer with the benefits given by my present employer. So it was very difficult for me. So
sure.
You rescued me.
Sure, sir.
Thank you, sir. So one last question. I think this has come from Ms. Vinuta. Is nominee entitled to withdraw entire amount of the subscriber? Is no more is one question. And there are a few more questions. I think I will forward it to the panelists at I think that'll be easier. If you can please answer the last one, please. Thank you.
Yes, this nominee can withdraw in case of unfortunate death, can withdraw the entire amount, and at the same time, nominee can opt for pension also. Both the options are open, so it's the choice of the nominee.
Thank you so much, sir. Mr. Mitra, over to you.
Thank you. Thanks. I think for me, I attended the last 1.5 hour session, and it's first of all a great informative session for me. Thank you to all the panelists. And if I have to sum up, I think Mr. Bandyopadhyay had started with the context why NPS is important, which I like very much, sir, because the aging population of India and the life expectancy is increasing continuously. And thus there is a need of look at around 20 years of life after 60. So at least average. So where the importance of NPS comes into picture. You have also talked about defined benefit, what does it mean and how the NPS is also working there. You have also talked about that 9,000 corporates are into the NPS system, but yes, very few of the employee joins since I represent a corporate, what we have told that if anybody is joining NPS, there is 1,000 rupees per month goes up into your CTC. Because as organization, as Bosch, we will contribute to you 1,000 rupees if it is you are investing in NPS. Otherwise, that money is not there to promote the NPS scheme, because as a corporate, we feel that this is a fantastic scheme and people should go in that direction. You have also talked about the comparison of changes, how, basically how less you are charging to have this NPS account maintaining, and there is no limit to contribution, only sources of income to be discussed. And also, finally, you have talked about the high return, which is CAGR 11.3%. And so more or less, I get a message that it's a 10% return, which people can get. Thank you, sir. Thanks for your contribution. Next, I come to Suranjan Banerjee. Suranjan, thanks for your insights. I like the retirement benefits planning, what you have shared. I think great insight was there. Thank you for your session too. Next, I come to Mono. Thanks, Mono, for your session. Yes, congratulations for your promotion too. And we have I have learned the Tier 1 and Tier 2, the concept of it and accumulation, how it happens, exit formalities, what are the premature exit, what are the normal exit, annuity service provider, asset allocation, and accessibility through web portal, which is real-time basis. I've also liked finally, which you have talked about, the grievance redressal with real escalation matrix on a real-time basis with a very time-bound way. Thanks for your contribution, Mono, too. And finally, I come to Ms. Kamdeen. Thanks for giving us the tax implication out of it. And I think you have given a very good comparison between a PPF and NPS, where as an individual, we get confused. And I really like the theory of exempt. That's a learning for me. Thanks for giving me that learning. You have also talked about that 40% corpus is fixed, 60% is defined contribution. So then there is a chance that you can decide your pension and how it is going to increase, and you can do your fund allocation and all those things. And finally, a taxable perquisite calculation. I think in detail you have explained. Thanks for that. It's very simple. At least I got it. So in Bosch, we have a pension benefit, and yes, we have a pension benefit, but it's a contributory pension, and I am contributing there as well. And my wish is, how can I, before retirement here, how can I transfer that fund to NPS? It could be a learning for me. Thank you. Thanks for all your contributions from my side, and thanks on behalf of CII for taking your time and all these things. Thank you very much.
Thank you.
Thank you.
Thank you. Thank you so much.
Thank you all. Have a nice day.
Thank you. Thanks to all the participants also.
Thank you. Thank you, Mr. Mitra.
Thank you.
Thank you very much. And please send across all the questions which we could not answer. We'll be happy to answer those questions also.
Thank you, sir. Thank you.
Sure. Thank you.
Okay.
Thank you to the organizers as well. Thanks.
Thank you, Mr.
Thank you.
Thank you.
Thank you. Bye.